An understanding and evaluation of an entity's system of internal control is a fundamental requirement of a risk-based audit approach. Under ISA 315, identifying and assessing the risks of material misstatement, auditors are required to obtain sufficient knowledge of the design and implementation of internal controls relevant to financial reporting in order to identify areas where material misstatements may arise. Internal control evaluation enables auditors to determine whether reliance can be placed on the client's control system and influences the nature, timing, and extent of substantive audit procedures. Where controls are effective, auditors may reduce substantive testing by relying on control procedures. However, where deficiencies exist, additional audit work becomes necessary to obtain sufficient appropriate evidence. Consequently, documenting and evaluating internal controls represents an essential stage of audit planning and risk assessment. Auditors employ several methods to record and document internal control systems, ensuring that the audit team obtains a comprehensive understanding of transaction processing and control procedures. The most traditional method is the use of narrative notes, which provide a written description of accounting systems, business processes, and internal control procedures. Narrative notes explain the sequence of transactions, responsibilities of employees, authorization procedures, document flows, and information processing activities in a logical format. They are particularly useful for documenting complex transactions or unusual business processes where detailed explanations are necessary. However, narrative descriptions may become lengthy, difficult to update, and less effective in identifying weaknesses within large or highly automated systems. Another widely used documentation technique is the flowchart, which presents accounting systems and internal controls graphically through standardized symbols and directional arrows illustrating the movement of documents, information, and responsibilities throughout the organization. Flowcharts provide a visual representation of transaction processing, making it easier to identify segregation of duties, authorization controls, reconciliation procedures, and potential control weaknesses. They are particularly effective for illustrating complex systems and facilitating communication among audit team members. Furthermore, flowcharts are easier to update than extensive narrative descriptions and provide a clearer overview of control relationships. Their principal limitation is that they may oversimplify complex procedures and require specialized knowledge to prepare and interpret correctly. A third common method of documenting internal controls involves the use of internal control questionnaires, ICQs, or internal control evaluation questionnaires. These standardized documents contain structured questions regarding the existence and operation of specific controls within various business cycles, such as purchases, sales, payroll, inventory, or cash management. Questions are generally answered yes, no, or not applicable, allowing auditors to identify missing controls or areas requiring further investigation. Internal control questionnaires promote consistency across audit engagements, facilitate staff training, and provide efficient documentation of control systems. Nevertheless, questionnaires may encourage mechanical responses without sufficient understanding of underlying business processes and may fail to capture unique features of individual organizations unless supplemented by additional inquiry and observation. Once internal controls have been documented, auditors evaluate their design and implementation to determine whether they are capable of preventing, detecting, or correcting material misstatements on a timely basis. Control evaluation focuses on whether appropriate segregation of duties exists, authorization procedures are adequate, reconciliations are performed regularly, physical safeguards protect assets, management supervision operates effectively, and information technology controls support reliable financial reporting. Auditors perform walk-through procedures, inquiry, observation, inspection, and limited testing to confirm that documented controls have been implemented in practice. Where reliance on controls is intended, additional tests of controls are performed to evaluate operating effectiveness throughout the accounting period before substantive testing strategies are finalized. During control evaluation, auditors frequently identify control deficiencies, which occur when controls are absent, inadequately designed, or fail to operate effectively. Deficiencies may include inadequate segregation of duties, lack of authorization procedures, poor documentation, ineffective reconciliations, unrestricted access to accounting systems, or insufficient management review of financial information. While some deficiencies may be relatively minor, others may significantly increase the risk of material misstatement and therefore require prompt management attention. The auditor should communicate identified deficiencies to management together with practical recommendations for improvement, thereby contributing to stronger governance and more reliable financial reporting. Particular attention is given to significant deficiencies in internal control, which are deficiencies or combinations of deficiencies that, in the auditor's professional judgment, are sufficiently important to merit the attention of those charged with governance. Significant deficiencies may indicate weaknesses that expose the organization to fraud, financial misstatement, regulatory noncompliance, or ineffective oversight. Examples include the absence of independent review procedures, ineffective information technology security controls, inadequate monitoring by the audit committee, or management override of established controls. Such matters should be communicated in writing to those charged with governance on a timely basis to enable corrective action. Although auditors are not responsible for designing or implementing controls, communication of significant deficiencies forms an important aspect of the auditor's reporting responsibilities. Despite their importance, internal control systems possess inherent limitations that prevent them from providing absolute assurance against fraud or error. Human error, misunderstanding of instructions, fatigue, carelessness, or poor judgment may lead to control failures despite appropriate procedures being established. Management override represents another significant limitation because senior management may intentionally bypass established controls for personal benefit or financial reporting manipulation. Collusion between employees or between employees and external parties may circumvent segregation of duties and other preventive controls, making fraud difficult to detect. Cost-benefit considerations may also limit the extent of controls implemented, as organizations cannot justify unlimited expenditure on internal control systems. Additionally, changes in technology, organizational structure, or business operations may render previously effective controls obsolete if monitoring and updating procedures are inadequate. Because of these inherent limitations, auditors cannot rely exclusively on internal controls when forming an audit opinion. Instead, they combine control evaluation with substantive procedures and professional skepticism to obtain sufficient appropriate audit evidence. A comprehensive understanding of internal control documentation techniques, evaluation procedures, control deficiencies, and inherent limitations enables auditors to develop an effective risk-based audit strategy while enhancing audit quality and supporting confidence in financial reporting.